Good afternoon, ladies and gentlemen, and again, welcome to this afternoon session. I trust you had some coffee and a good lunch from the session in the morning, which was also very engaging. This afternoon, we have a topic, de-risking portfolio assets in post-COVID situation, a time for reflection. And again, I have with me a distinguished panel of both experienced commercial bankers, development bankers, and consultants who have worked in the region for some time. With me, and I'll start off with Miss Diane Kalusisi. She's the Chief Executive of the Bank of Kigali. Next is Bernard Robson Magulu is the Executive Director of the Bank of Africa in Uganda. And of the third panelist this afternoon is Mukola Ntambwe. He's a Principal Investment Officer with Africa Development Bank. And then the final panelist this afternoon we have is Mr. Demba Tandia. He's the Vice President with TCX and is in charge of structuring and sales. That is the panel this afternoon. Ladies and gentlemen, we expect an engaging afternoon. And the question which to our mind has been, is the pandemic no longer in the driving seat? Obviously, considering that we have to de-risk our assets in the region, we are all aware that economic recovery remains quite uneven across the regional markets. Several analysts remain optimistic that some countries have already gone out of the pandemic, but recovery across sectors remains a challenge. Sectors like aviation, hospitality, and tourism are expected to recover only after 2 years, which means economies within the region that depend on tourism will remain vulnerable. Indeed, uncertainty in the region remains high, and risks remain real to both regional economic recovery and government fiscal turnaround. However, analysts agree that the pandemic impact on regional banks was not so severe as expected or as anticipated. The average return on equity for regional banks did fall slightly in 2020, but remained within acceptable ranges, and is expected to rebound in the next year or so. Why then are regional banks taking bold decisions on expansion? Is bank consolidation coming in form of expansion? These are questions that we are putting out there to understand. We really look at the impact of regional banks on financial access, banking competition, and financial stability. The impact is quite noticeable in their exposure to small and medium-sized enterprises, a segment which to some say is prone to higher default risks. Regional banks are driving competition in banking sector. Several are even expanding regional presence. However, considering the recent shocks of the pandemic to the banking systems, there is fear also that regional banks could become conduits to transmitting cross-border risks across countries. Could we then affirm the emerging migration risk on bank loan assets? One significant challenge faced by banks during the pandemic was the immediate increase in the number of non-performing loans. Layoffs, salary cuts, and low demand and low purchasing power crystallized immediate events of default. Indeed, the pandemic inflicted enormous stress on bank operations. However, many banks have handled the challenges well. Overall, relatively smooth transition to the new virtual operating models is evident in the operational resilience. Already, rigorous credit loss assessments have assisted banks in better risk containment and pricing of their credit facilities. It is already visible that banks are better prepared to mitigate emerging credit losses. Going forward, technology will be essential and critical in helping banks to deliver on productivity. In the short term, banks are leveraging technology to simplify and automate credit processes. and taking a more granular approach to managing and assessing credit risk. In the longer term, banks will likely need to move to the platform-oriented digital architecture. And again, leading regional banks are already showing potential to reduce costs through such initiatives. The argument to digitalize portfolio-level credit monitoring tools must be embraced by all financial institutions. Most banks are on board already, given the urgency and frequency for loan book reviews and the individual case assessment of counterparty business models, which then determine the transactions that they onboard. I think, ladies and gentlemen, we are looking at a situation where how do we embrace de-risking instruments and respond to the increasing regulator demands? In the context of debt crisis, banks are still expected to optimize their costs of risk and to reduce cost of risk management. Digital analytical tools hold significant potential in helping banks to earn immediate return to growth. For example, the use of analytics and real-time reporting could transform risk detection, linking early warning data systems in identifying potential defaults. Augmenting systems with additional publicly available data sources could help banks gain more acute understanding of markets. Ladies and gentlemen, I think I've already introduced my panel, and I believe this is an opportunity to bring in an innovative banker who has led one of the regional leading banks for some time now, and she will give us some perspectives around how technology could still continue to lead in terms of de-risking assets within the region. Over to you, Daniel. Diane, sorry.
Thank you. Thank you, Wycliffe, for having me in this very interesting discussion. So indeed, banks are transforming. I believe it's a question of survival. It's not an option. We have to transform the way we do business. And we all understand now that being a digital bank is not just having an app or having channels like a functional internet banking solution. So we all understand that we have to be more and more embedded in other digital ecosystems because people, clients, the youth in particular, people who are now coming to the workplace, they don't look for a bank. They look for services. They look for mobility, for transport. They look for, they want to rent a house, etc. And we have to make sure we embed ourselves in what the people are looking for. So if I'm looking for protection, health insurance, etc., we should be in a platform or in an ecosystem that helps the client select what's the right protection for him or her. And then when he or she makes a transaction, the bank backend systems are supporting him or her to make this transaction. So that's what we are thinking, how we are thinking about digital ecosystems. We have, for instance, in Rwanda, a company that is in charge, that has digitized mobility, and people all pay their transport fares with a card. We call it Tap and Go. And we're seeing how we can get these cards to also become a bank card. So you can have credit, you can purchase, you can use the card as a normal banking card. So this is how we are looking at digitization. And we believe if we don't, because banking services are becoming commoditized, checking services, current accounts, etc., all banks or even some entrants, fintechs, are going to be able to offer these services at a lower cost, more efficient because they don't have the bank infrastructure that we have. So we understand that we really need to get embedded into digital ecosystems. So we support clients who are not necessarily looking for banking services, but who are looking for everyday services like transport, buy a house, rent a house, look for protection, etc. And we help them as part of the ecosystem to support them. So we are looking at a number of integration with partners because we believe that's the best way for us to get a view of clients beyond the KYC. We want to know how they spend, what they spend on, who they are exactly, etc. And this these partnerships are going to give us a big visibility on, on our clients, and this is going to help us in our assessment. We're talking about NPL impairments. The more data you have, the more data-driven your business can be, and you're able to see how to assess creditworthiness of clients without only counting on an integration with the credit reference bureau or the past deposits. You are able to have a bigger view of the client and able to make better decisions. So I think that's what I would say. And on the issue around how we are managing NPLs and what's the trend of impairments, I believe you've seen this in our financials, because last year we all took a very negative view, and this was embedded in our IFRS 9 or provisioning models, where we had taken a macro overlay that had an impact to increase all probabilities of default and significantly increase our impairments. So now what we're doing is reviewing this macroeconomic overlay, but we are keeping a very, very prudent stance for some sectors like hospitality, as you say, tourism, aviation, because we can see recovery in most other sectors, but not there. And we've taken a two-pronged approach. For other sectors, we've gone back to normal economic conditions. But for these sectors that we believe are still under enormous pressure, we've taken a very prudent view. That's why you'll see in our financials that we keep a cost of risk that is, still higher than pre-pandemic levels. And we hope that gradually we'll be able to release some of these provisions and have an impact on our profitability. I think that's what I would say for now. I look forward to a very engaging and interesting discussion. Thank you, Wycliffe.
Thank you, Diane. Thank you for bringing in that data-driven businesses. I think as an institution, that is really very important in terms of digital transformation, and at the same time, de-risking even your loan assets. If you have that on them, then it's much easier to really de-risk those assets. We are moving on again to Bernard now. Bernard is coming in with a perspective on how banks could be consolidating in the region, given what we have witnessed on the COVID pandemic. Bernard, over to you, please.
Okay. Thank you very much, our listeners, the viewers, the organizers, and the comrades on this very high level but practical conference and discussions are very, very topical. First, I would like to address myself to the fact that prior to COVID, financial industry services had evolved steadily, driven mainly by changing consumer expectations, heightened competition, evolving regulation, and embracement for technology had taken a very good state. However, the emergence of COVID has forced very, very radical changes to customer behavior, moving significant portions of the economy in terms of online and increasing customers' willingness to engage digitally, though they never wanted as well, because that was a progressive process. But this urgency has meant that digital transformation agenda has now become more apparent. Now, in addressing ourselves to the banking sector, we realize that because of this COVID that we are not really ready for, in East Africa, COVID has impacted us differently in the banking sector, because the adoption and the measures and the way we have come out, or we are coming out, is gradually being revitalized at different levels. For instance, if you take the aspect of Uganda, we realize that there are certain sectors that have positively been impacted by COVID right from the beginning. And there are those sectors that have been adversely impacted. So the players within the industry, for instance, education, hospitality, hospitality sector, and transportation has been very, very adversely impacted. If you look at Uganda's economy, you know Uganda is land-linked. And because it is land-linked, so transportation becomes a problem. And we need to move items. So if that sector right from the beginning had been impacted, it meant that the borrowers who we extend credit in those areas that I've mentioned become constrained. Needless to say that even other sectors faced similar challenges. Whereas manufacturing remained open within the region, we still had, because it depended on other sectors in order for them to remain operational. So that meant that the cost of operation went out, the cost of borrowing, notwithstanding that there was muted demand. And because of this muted demand, followed by layoffs, lean management, cost optimization initiatives, we have seen that financial sector has changed invariably. We had to move on. And because of that, I noticed that regionally and globally, banks need to encounter these strong winds with things like net interest margins have been depressed, lower rates, lower demand for loans due to this pandemic. Now, in order for the financial sector to move forward, they have now to recalibrate and understand how are they going to move from one step to the other. And in order to do that, there is a refocusing and leveraging fee income, for instance, primary players to drive growth, but such prospects, because of the economic and very somber macroeconomic fundamentals within the region, we have seen that banks, those with scale, those that have global account management, those that have group arrangements, then they are more likely to withstand those kind of challenges than banks that are really coming out internally. So we are seeing an emergence of organic growth. And this emergence of organic growth has led to a post-pandemic world to unleash structural and systematic changes across multiple industries. This means there is a highly asymmetric across regions, sectors. Most industries, including banking, will need to reinvent themselves to thrive through mergers and acquisition, are expected to have a strong influence in shaping the next normal if we are to continue resilient. Now, what are the challenges that banks are facing as a result of this? The drivers were once very favorable, continued with these kind of activities. I think at some point there is a discussion on capital markets that will help us to understand scale of efficiency and the search for digital capabilities. However, we see in the region that in terms of these mergers, for instance, in February, Equity Bank Congo, EBC, a subsidiary of Equity Bank Group, successfully merged to form the Equity Bank Commercial du Congo. Similarly, we are seeing some of these elements in Kenya. KCB Group approved some kind of proposed arrangement to acquire Bank Popular di Rwanda, BPR, and African Banking Corporation, Tanzania as well. These are some of the elements where they are seeing some changes. Now, What does this mean? Boards, shareholders, and executive will need to stress test, assess impact of COVID-19 in their books and in sectors such as hospitality, travel, energy, education, and continue to assess what is the impact on capital. So capital formation, capital management, and the consequent impact of IFRS, new elements by Basel, for instance, ILAP. These are key fundamentals that need to be tested in order to manage resilience for the future. Ladies and gentlemen, it is needless to appreciate that de-risking has taken a progressive turn in the post-pandemic period. De-risking for money services, foreign embassies, non-profit institutions is something that has evolved over a period of time, but it is now being focused on relationships to avoid and manage risk on certain businesses that are perceived to be very, very high risk. Now, in terms of the future and the de-risking parameterization, we now see that commercial banking industry trends need to apply themselves on elements like accelerating digital transformation, focusing on recovering credit losses, and in this, better assessment in terms of pricing models and giving credit to customers whose risk parameters within the tolerable, acceptable levels becomes imperative, strengthening operational resilience, mitigating crime, because this is another area where we need to strengthen the operational capabilities in terms of the IT framework to mitigate external threats, adapting to evolving regulatory environment. And then finally, for us to appreciate that as we do all these, we need to ask ourselves the fundamental questions. For instance, in Kenya, will COVID-19 lead to consolidation in Kenya? Yes, we already see that at least 4 banks and maybe others are to emerge. Then key hedging and de-risking instruments. Currently, central banks are positioning things like swaps, and then major government and central bank actions to support vulnerable sectors in terms of interest waivers, direct financial support to negatively impacted sectors. What about in Uganda? In Uganda, similar discussions have been underway, and some banks, because of the change in the anticipated capital, which the central bank is already quoting commercial banks, we see that the environment is likely to change. And in terms of hedging, of course, we are seeing SMRs have lowered from 8 to 6%, and major government support on these sectors are credit holidays, waivers on interest rates, overnight guidance on treatment of education and hospitality sectors. And what about in Tanzania? And in Tanzania, our focus is that probably no such plan due to COVID. We continue to see, watching what happens as well, but key hedging instruments noted, not very evident, but probably in the offing. And in terms of government direction, the government has put in place economic recovery fund to support most affected sectors. And lastly, what about in Rwanda? Yes, we see that probably this kind of consolidations, the industry continues to watch. In terms of de-risking instruments, probably something is yet to be put in place, as well as on the government action plan to support. Government has put in place the economic recovery fund to support these sectors. Ladies and gentlemen, finally, I believe that the pandemic has brought unprecedented challenges to the financial sector, ranging on how clients should transact, how banks should position themselves to meet the ripple effects of these negatively impacted sectors and the asset portfolios. We can see in summary that over 8 major discussions are going on in Kenya, Uganda, and Tanzania, and aspects in Rwanda. Some are in advanced stages, while others are yet to be concluded. The regulators have responded swiftly to shore the sector from these shocks with demanding and guiding on prudent asset quality management measures. We expect capital requirement adjustments. This has started in Uganda. We expect to see how other regional players respond. And finally, my comments on de-risking and financial inclusion. Financial inclusion, not exclusion, should be at the heart of the risking financial sector in the region, in the continent, and at the globe. It is delicate balance between industry players, including regulators, academicians, and also the shareholders. But what is required is to have dialogue of minds and also probably change and continue a rethinking of how strategy formulation and execution is being done. And this brings in the new temperament of trying to understand how blue ocean drift or thinking is very helpful. Lastly, thank you very much for listening to me. Please do not forget the presentation that has been made by the Prime Minister at the Economic Forum that is taking place in Glasgow, in where he's saying it is time now for us to help. It's time now to help the vulnerable. It is time now to rescue and make the financial sector vibrant. It will require all of us and the stakeholders at large to play a significant role. Thank you very much for listening.
Thank you, Bernard. Again, thank you for the elaborate, issues around the region you've raised in terms of differences in the way banks are consolidating. We're looking inside the country, are looking regionally to make sure we address issues that affected banks in relation to COVID, but at the same time giving them opportunity to expand and consolidate further. The inorganic growth around there is a very interesting aspect, and the subsector analysis tools proposed are also another aspect to really interrogate further. I think without further ado, I just want to bring in Mukola here. She manages quite a portfolio in terms of the development bank perspective. Mukola, what do you have to say on in terms of the way regional banks are moving? And again, how are they de-risking their assets? Over to you, Mukola.
Thank you, Wycliffe, and good afternoon, panel, and everyone who's online, watching or listening. So I'd like to convey my deepest appreciation to the Trade and Development Bank for including me in this very high-level panel to discuss a very topical issue. So that I go straight into the point, I'll break down my presentation into three. One is, the first point I'd like us to quickly go through, because these are facts that we're all well aware of, is the different government directives that were issued at the onset and during COVID. And secondly, just look very quickly at the quality of assets across the banks in the region, and as well as what the FDB, especially the East Africa Regional Office, has been seeing in terms of demand from our various stakeholders and counterparties. So if I quickly go through my first point, this is the directives that were issued across the board. I must say that I'm speaking from observation, as well as the fact that I look at mainly a portfolio of banks in Tanzania, Kenya, Uganda, Rwanda. And I'd say that in the countries that I've mentioned, most responses were to encourage FIs to really accommodate assets that were more exposed to the effects of the pandemic. And the response of most banks was really to restructure their portfolio, as well as to give measures that would offer relief in terms of repayments. We also saw governments requesting, or rather promoting, e-payments, and this brings in the ongoing wave of adoption of alternative financing channels. I can speak for the regions that I've mentioned. We've seen a bigger uptake of digital payments, e-payments. We've seen a bigger uptake of alternative channels with regards to payments and trade transactions. And the third thing that most of the governments had requested was a reduction in cash reserve ratios. And this was across the region, but more so in terms of the response. We've seen many governments actually formulating stimulus packages to support the more affected economic sectors. I hate to repeat what both the first and second speaker have said. We all know that aviation, hospitality, education, real estate, and to some extent logistics and general trading, and to some extent manufacturing were affected and did receive some accommodation from the banks. But more so, I'd like to speak of the various response credit facilities that multilaterals were quickly to come to the table. As I speak, we have four recovery credit facilities that are from the IMF, the World Bank, the FDB that are currently in implementation. So as you can see, the government quickly acted in terms of giving directives to the FIs to basically help accommodate the economic sectors that would be and had been affected by the pandemic. And also we saw a quick uptake in terms of implementing not only the directives, but also banks looking inward, meaning looking at their own formulation of new strategies. We've basically seen banks being really taking, I could say, two broad approaches. One is building resilience, and another one is, creating an environment of agility. So speaking for the bigger regional banks, these are banks operating across the region. I've seen the strategies moving more to defend in terms of balance sheet optimization, as well as slightly aggressive in terms of ensuring that not only do they optimize the opportunities that the pandemic has created, but also help their customers fare, or rather chart their way through this pandemic. And I should just say that banks have moved from the COVID quote unquote pandemic into the new normal, and it's a different normal, but it's a normal that has been adopted by many of these strategies that I've seen. So if you'll allow me to quickly just take you through the quality of assets that have been affected, we find that this is just very generally speaking. More than 70% of the assets in the region would say are performing, and probably about between the level of 10 and 15% that have been accommodated and continue to be accommodated by the various measures that the banks have taken. But moving on to the sectors that have been affected, our observation is sectors that deal in real estate, trade, as tourism and hospitality, as well as to some extent manufacturing. But let me just stress on this point. In terms of market segmentation, what we've seen is a lot of the SME sectors being, in terms of the distribution of the effect, the sector that has been affected the most is the SME sector. Just looking very roughly across the region, we see that between 60 and 70% of the SME of the portfolio that has been accommodated and has been affected by the pandemic is the SME sector, relative to the large enterprise sector. So it's north of 60 to 25-30%. So as you can see, the SMEs haven't been able to weather the storm, as well as the large enterprises. And this brings into my third and probably the last point of not only my observation, but also the type of requests that we have seen. If I may add, between July and September, we did a deep dive of the sector that was accompanied by a business development mission. This really involved high-level discussions with various banks, both regional as well as local. And normally you'd find that the requests, these business development missions lead to transactions. But what we've seen, or what change we have witnessed in terms of the requests that we're getting, we're seeing more of requests to provide capital buffer. This is really tier 2. So various banks, and this I must add is not just limited to the larger regional banks, but I've also seen this request coming from the tier 2, tier 3 banks, where they feel that there's a need to basically provide resilience in their capital, as well as build in the tier 2 capital in the form of sub-debts. We've also seen a drive for digitalization, and this has been explained well by Diane, and as well as the second speaker, where we've seen a bigger interest on our Africa Digital Finance Initiative. So as you well know, this initiative is really to provide banks as well as other financial sector players with technical assistance in building their alternative financing solutions. We've also seen a big demand for risk mitigation. As I said, a lot of the sectors that have been affected, if you look at sectorial distribution, it's the SME sector. So you find that a lot of the banks, and I must say that the majority of the banks in the region are really SME banks. The bigger portfolio, that most of these banks are your small and medium enterprises. And what we see more of is a request for portfolio as well as credit guarantees. So the portfolio guarantees really are to mitigate certain segments of their assets, and these are generally the SME. We have also seen an increase in demand for hedging instruments, and TCRX will go through this, and therefore I shall not spend too much time on it. And following on to the second speaker's observation, and I'm speaking from observation, is that we have seen a lot of mergers and acquisitions, if not implemented, but in the plan. We've seen Equity Bank expanding into the DRC. We've seen the KCB acquisition of Bank ABC and BPR, as well as CRDB Bank Tanzania going into the DRC. So my point is that the banks have quickly adopted to the new normal. And what we tend to see in terms of asset and risk mitigation is banking looking within, protecting their own balance sheet in terms of creating capital buffers, as well as seeking products that could basically mitigate and also adopt alternative channels. I must mention that, as much as they're looking inward, banks are looking at not your usual client base or clientele. The demands for the products that we see and hopefully hope to deploy from the year 2022 going forward are your unusual products. These are products that are related to gender financing, climate resilience financing, digitization, as well as financial inclusion. So I would like to end here, and I'll be open to any questions. But as I said, my talk or my presentation is basically basically leaning on observations that I've seen in the market, and these are observations. Yeah, so these are basically observations that I've seen across the 4 countries that I have mentioned. Thank you very much, Wycliffe.
Thank you so much, Umkola. And again, the idea, the perspective from the multilateral initiatives and de-risking instruments that are available within the region to make sure that commercial banks continue to perform effectively. I mean, the risk sharing initiatives that perspective is really very important to us. You've given us an insight into the credit facilities that are being provided, the capital buffers that are needed by banks to make sure they address the challenges experienced from COVID-19. The idea that it wasn't just challenges, but opportunities to share and work and risk share together is a very important aspect. I'll move on now to Demba. Demba is from the TCX, so ideally he should be able to give us some insights on de-risking instruments, hedging instruments that are available, not only for banks, but also to the private sector companies out there. So over to you, Demba. Thank you.
Perfect. So thank you very much, Wycliffe. I don't know if you can hear me, just a test.
Yes, we can hear you loud and clear from Paris.
Excellent. So thank you very much for having me for this special discussion with all the co-panelists, all the attendees, and special thanks to the CDB and EIB for organizing this annual forum. The advantage of being the last to speak is that I can go straight to the point because all the different topics have been well covered by my co-panelists. So thanks for all these different points. So maybe let's start first by just presenting TCX, who we are, before going in more detail. So TCX, is a development finance initiative. So we exist in order to provide currency hedging solutions in frontier and emerging markets. So we were founded in 2007 to absorb the currency risk. So especially when COVID came, you see that all the financial sector was exposed to a lot of risk. First of all, the first risk was liquidity. And as Mukola said, all these governments across the world have supported the banking sector by first providing liquidity assistance to the banking industry. And of course, reducing interest rates. This is very important. But the third risk, which is not very easy to manage, is the FX risk. So if you just look at the different figures during the last years, when you look at the FX rates, they all gone down. So when FX rates go down, you may face some losses, and especially not only for the banks, but also for their own clients who can be exposed to FX risk. So at TCX, we exist in order to take this risk. So we not only share the risk, we take the full risk on our own balance sheet. So in order to do that, we have the support, as I mentioned, for approximately 20 shareholders, which are constituted by a group of leading development finance institutions, such as multilaterals. Thank you. From a special thank for African Development Banks being one of our anchor investors, but also all these huge multilateral banks and bilateral banks across the globe. We have also some strong shareholders from the private sector, from the private sector industry, which are very active in emerging and frontier markets. So at the end, we are also backed by 5 government entities. From the German governments, but also from Netherlands, UK, Swiss, and at least the European Commission. So we are strongly capitalized. We have more than $1.3 billion in terms of capital. So this capital is here to absorb the risk we can take and we can offset from the financial sector. Not only the banks, but as I mentioned, also their own clients, but also from within the microfinance space, where local currency funding to finance the asset in local currency is crucial. So at TCX, we provide let's say 2 products. The first one is the FX forward, especially well tailor-made for, let's say, some shorter transactions. And the second product, which is the more developed we offer to our clients, are cross-currency swaps for tenors going from, let's say, 2 years onward. I have to emphasize that the fact we are able to take risk in a very long-term periods is crucial, especially when you have some large exposure when it comes to FX risk. For example, a lot of banks can attract capital offshore using the capital market, but also from some GFIs in euro and US dollar. But at the end, if they use this fund coming from offshore level to fund local currency assets, they are facing mismatch in terms of asset and liability management. And here at TCX, we are able to manage this risk by offsetting it from the banking sector and the microfinance sector also. So I wanted to also emphasize maybe 4 key principles that guides our business operations. The first one is we do not speculate. We exist here to offset this risk, especially when it's come to pandemics. And the COVID-19 show us that how FX can be very volatile and can affect some businesses. So we are here in order to protect the different actors facing this risk, and we do not speculate. That is very important to mention. The second point is regarding the pricing. We are all our pricing are market-based pricing. So we just look at the different interest rates where government bonds, for example, trade within the onshore capital market and try to build our own pricing. And from time to time, we can have some specific program designed to unlock transaction, for example, by subsidizing some transaction. For example, this year, we worked closely with the European Commission to see if we can unlock some deals within some currencies. It was 16 currencies, but I can give you some examples within the East African side. Burundi was covered. Ethiopia, for example, was also covered. The third point and principle I wanted to mention is our additionality. So we provide hedging solutions where commercial banks or commercial actors are not active. So today, if let's say a bank in Uganda or a bank in Kenya or a bank in Rwanda or a bank in Rwanda or everywhere around the world, they want to hedge some exposure they have relating to FX risk, we are able to provide such instrument to protect them in terms of volatility of the FX risk, but also in case of depreciation. So when crisis came, you all see that currency come down. And at the end of the day, it's making the banking sector more resilient because they have some tools to manage risk, not only the liquidity risk, but also the credit risk, but also the FX risk. So this is very important when it comes to contracting some hedging instruments which are not available on the market, especially for longer tenors. And at least the fourth principle I wanted to mention is, of course, reliability. We are here in order to construct a very long-term business partnership with all the different actors, not only the banks, not only the microfinance institute, but also some the private and the clients of the banks. So after this, let's say, brief presentation, of course, if you want to know more about TCX, our website is available and you can see all the different information there. Of course, we will be more than happy to rely on it on a bilateral basis. Let's go on my side to, let's say, some numbers and quantitative elements can be more concrete. At TCX, we cover more than 100 currencies across the world and pretty all African currencies, not only the East side, but pretty all the continent. As an example, we are very active in Kenya. It is one of our most biggest exposure within the fund. But we are also active in Tanzania, in Uganda, and also in Rwanda. So since the inception of the fund in 2017, we hedged around $8 billion US, of which sub-Saharan Africa represent around 20%. So sub-Saharan Africa, it's a huge part of our exposure. So the remaining is well balanced between Asia, Europe, Central Asia, Latin America, Middle East, and North Africa. So I wanted to finish here with my introduction. In terms of production per sector, financial institutions represent around 90% of our activity. So 70%, is covered for microfinance institutions, and remaining 20% for financial institutions such as banks, which are very active within the SMEs finance space or other business related to their own clients. So I will leave it here to optimize the discussion and to leave more rooms to question and answer for us. And I will pass it the baton to Wycliffe. So thank you very much.
Thank you, Demba. Thank you. Again, the idea that local currency hedging, I know local currency has always been an issue within the commercial banking sector, and the instruments that are being introduced here by TX are fundamentally de-risking instruments that can assist both the private sector, commercial banks in making sure that they hedge against these risks. It's a deeper conversation we will have, but I can see we have a few more minutes where we will just quickly answer some questions. If I may just prompt you, Diane, there is a question on the chat in respect to the bad bank models and how to reduce NPLs. I think there's a talk around securitization. Is this something that commercial banks are thinking about as in our region yet? Diane.
Thank you. At least in Rwanda, I don't think we are taking that approach. What we've seen is that the government has come to a rescue with the Economic Recovery Fund that has refinanced some of these loans for sectors most affected by the crisis. So what this means in practice is that we banks borrow at 0%, and we on lend at a very subsidized rate. In our case, it was 5%. This is to be compared with market rates of 15, 16%. And we on lend to refinance the facilities from these sectors, hospitality, tourism, etc. So this, in fact, has reduced significantly the finance costs for these companies. And we are seeing many of these clients being able to service the facilities, although occupancy rates have significantly dropped to the level of 10, 15%, but because the finance costs have reduced significantly, we are seeing some of our clients surviving the crisis as they wait for better days. So maybe something that should be considered is for clients that are heavily leveraged. Maybe we can look at a fund that can take an equity position in these businesses, and then of course this equity position can be sold. We can look for an exit for these investments in the future when the situation has improved. So this is how we are managing it. We have a considerable amount that is invested in these sectors, hospitality, because Rwanda has invested significantly in the hospitality sector in line with the tourism and conference tourism strategy of the government. So the support we got from the Economic Recovery Fund was very, very relevant. But if this situation persists, maybe we need to look at other ways of supporting these clients. Thank you.
Thank you, Diana, for that. Again, it's initiatives both coming from government, but allowing commercial banks to really go in there and look at the assets that are experiencing distress. I don't know if, Bernard, you have some examples from Uganda to that effect in terms of de-risking instruments that have come up in the region to support sectors that have experienced problems aside from the government initiatives.
Okay, thank you very much, Wycliffe. To start with, there was a question that was running on the fora that required me to give some kind of examples, some percentages in terms of the extent of this impact in East Africa or even in Uganda, and in particular the employer I work for. One thing that I need to put across is that you realize that in all these East African countries, Uganda has been hit the most in terms of going in and coming out. So coming out is extremely very, very gradual. And because it's gradual, for instance, it is now 2 years, the children have never gone to school. You can imagine what is happening to the education sector, the private sector players. So as a result of that, of course, the central bank has came up to give a moratorium. And because of that moratorium, which was available to all those sectors or individuals that by the time when the COVID took place, they had been constrained. And then they have had other additional conversations with the commercial banks, and within Uganda Bankers Association, our umbrella organization, we have seen some kind of additional consideration specific for the hospitality sector as well as the education sector. Now, in terms of percentages, of course, as I've said, that Uganda has been hit the most. So because of that, you'll see that there are more restructures within Uganda than other East African countries. Maybe that is to give a flavor on that. And what is currently key and important is a deep dive appreciation and understanding of customers through cash flow analysis. And this is not academic, it's a practical. You need to sit with the borrower and understand, do they have alternative cash flows? How have they been impacted? And you see, how do you work with them so that you can help them come out of this situation? Then in terms of the de-risking instruments, I've given, that's what the government and the central bank has put together alongside with the umbrella organization under Uganda Bankers Association. Of course, other elements now remain on the individual financial institutions to take prudence, to embrace the likes of instruments that my colleague Damba is putting across, and see how these can be applied on particular institution, in the particular sectors, because a sectorial appreciation and understanding of how these sectors have been impacted in Uganda and in East Africa. And because I remember he resounded saying Uganda is landlocked country, but it is road linked. So you find that different sectors that help us in the value chain, in the ecosystem, have been impacted differently. So you will require very creative and deep understanding of risk mitigation and revival strategies. Thank you very much.
Thank you. Thank you so much, Bernard, on that note. I think we are coming to the end of our session. It's been a very interesting session. I know there will be opportunities for us to engage further on the questions that have come up on the chat. Going forward, again, we need to upscale as FIs to see how best to de-risk our region. That is coming up very strongly, and how commercial banks in themselves not to look only internal on themselves, but there are facilities out there in the DFI space that could continue to de-risk the bank assets in our region. We thank you, the panel, for the robust engagement you've put up, the issues that have come up this afternoon, and we believe we can continue to engage further on this. Thank you so much for making time for this session, and bye for now.
Thank you, merci.